361 is an asset management company with a 16-plus year track record of exceptional performance. They manage unit trusts, hedge funds and segregated mandates with over 32 billion rands in assets under management. And our speaker today is Steven Hurwitz, who is an investment analyst with 361. He's been with the firm for over 5 years, and Steven placed fifth nationally in the SICA board exams and is a CFA charter holder. Steven, over to you.
Thanks, Michael. So it's great to be here and just introduce everyone to 361 Asset Management and just take you through what we do at the firm, specifically with regards to hedge funds. So we've been around for a pretty long period of time. It was started by Cy Jacobs and Steve Lips in 2005 after they left Investec. And we really believe that we have one of the best investment teams in the country. So it's a small owner-managed business. There are 22 employees, half of whom are part of the investment team. And that allows us to really go in depth and understand the companies that we're analyzing and therefore take advantage of the opportunity set that's available to us. So how do we see the outlook in equities, and how have we positioned our portfolios? So I think the important thing to realize is that we are transitioning from being in a pandemic, and COVID's now become endemic, and all it took was a global invasion or a Russian invasion of Ukraine for us to forget about COVID case numbers. So I think it's quite important to understand some of the themes that are going to go along with that. And we're going to see a resurgence in the consumption of energy and oil specifically. So we are far away from when oil actually was negative at the height of COVID. And now it's over $100 a barrel. And one of the biggest beneficiaries, or one of the only beneficiaries on the South African market, is actually Sasol. So we see that as a good opportunity. We also believe there's going to be policy normalization in South Africa. And lastly, we still believe there are lots of equities that are attractively priced. So there's been a huge run-up in the market, but you just need to see through some of the volatility and realize that on a normalized earnings basis, many companies are still trading way below their intrinsic value. British American Tobacco being a prime example of that. So how have we prepared for this kind of environment we see ourselves in now? We tend to do really well during bear markets or during market sell-offs. And we have a very good understanding of how market participants act during these kind of market dislocations. So some of the things we need to do is we need to cut exposure. We need to hold more defensive companies, but also understand that there are certain companies that will benefit regardless of the situation that's taking place. So currently you can see that commodity companies are doing extremely well due to what's going on in Russia, and they can hedge your portfolio. Even if you long those companies, they can act as a very good hedge to some of the other companies. So one very common misconception that we see in the market is that people believe that hedge funds are extremely risky investment vehicles. And unfortunately, a lot of them are risky and a lot of them are obscure in terms of the strategies that they embark to use to make money. But in the case of 361, it couldn't be further from the truth. We are way more defensively positioned in our hedge fund than we are in our long-only funds, and we pride ourselves on our ability to protect capital in market corrections. So this is just an example of how we've done this in the past. As you can see, there are three different market environments. The first one is when you have positive months on the JSE. The second one is when you have negative months on the JSE. And then the third one is when you combine the two. Now, because we have less exposure than the market, when the market's strongly rising, we'll never keep up with the market. But where we truly shine is when the market falls. So on average, when you have a negative month on the JSE, it's down about 4%. And we're only marginally negative. And when you combine these 2 months, up months and down months, it results in us consistently outperforming the market to the tune of about 4.5% per annum. Just an example of what we'd do is we'd go long a company and we'd go short a similar company or in the same sector. And that helps us hedge out some of the sector risk and really focus on the company fundamentals at play. So for example, this year we were long Google, which has performed reasonably well, but we paired this up with a short in Affirm. And Affirm is one of these buy now, pay later lenders. And this was all the rage during COVID, but we thought it was very much a fad. And there still was a significant amount of credit risk that these businesses were taking on. So while they were growing their top line tremendously, we weren't really seeing this translate into free cash flow for the business. And as central banks around the world spoke more about normalizing policy, some of these inflated valuations came back down to earth. So why, as an investor, should you consider hedge funds? How does it fit into your portfolio? So I think the important thing to realize is that by choosing a selection of different long-only funds, you're not actually diversifying. So this just says, what happens if you took a portfolio and allocated to 5 different South African managers, the 5 biggest in the country, and how would your performance be relative to the market? And as you can see over time, you actually end up underperforming the market. And part of this is due to the fees that each of these managers take. But the other part is when you have 5 different managers, you're actually just getting market-like performance because you're so well diversified. If you have a look at the 361 hedge fund, on the other hand, our correlation to the market is significantly lower. I think when you run that exercise with the top 5 equity funds, you end up having 92% correlation to the market, whereas we're sitting at 51%. So it brings diversification to your portfolio. Now, for a lot of investors, the way they'll go about reducing risk is by having a bond allocation within their portfolio. So if you go and take 60% equities, 40% bonds, that's what your return metrics would look like on the left. So you'd have 10% performance, 10% volatility, and an over 20% drawdown. Now, if you swap out that portfolio and add the 361 hedge fund, reduce the equity to 30% and the bonds to 10%, you end up increasing your performance by nearly 4%, but on top of that, you've actually reduced your volatility. So your Sharpe ratio of your entire portfolio is significantly better. Now, something we often think about at 361 is just what is the risk of having a drawdown in your portfolio. And mathematically, as the drawdown gets bigger, you have to recover a significant amount more. So during the COVID sell-off in March 2020, we were down just about 1%. And to get back to where we were, we hardly had to make anything up. But for the all-share index and for the cap SWIX, as your loss got bigger, you had to make a significantly amount more money. So if you have a 50% drawdown, for example, you have to make a 100% return just to get back to where you are standing. So how does this fit in for someone's investment portfolio? And I think a great example is to show people who rely on their portfolios for income. So in a living annuity, let's say you have a lump sum put in upfront, and then every month you have to take a salary off that, and every year that the amount that you need to draw increases by inflation. How does that work? So in the first example, this just says, okay, you put R1 million in lump sum, what do you end up with at the end of the investment period? And as you can see, your money in the hedge fund is worth 87% more than if you had just invested in the market. But you also would have had much lower volatility along the way. But where it truly shines is the example where the person is taking an income. And the income that you're taking results in you having 137% higher ending portfolio value. And the reason for this is that when you have a market correction, you're still required to take an income. So now what's happened is you've taken an income and it becomes a larger percentage of the portfolio that you're drawing. And then just to get back, you have to earn significantly more. So for investors that are relying on drawing an income from their portfolios, having a conservatively positioned hedge fund as part of their portfolio results in much better return metrics and helps you sleep at night as well.
Well, Steven, thank you very much. I mean, there are a couple of questions I want to get in, so I'm just going to dive in because we are running out of time.
Sure.
When you're positioning a hedge fund during a time like this, huge geopolitical uncertainty, how does that factor into the way you're positioning your hedge fund?
So I think the important thing for us, or at least a lesson that we've learned, is that you can't take bets on 50-50 outcomes. So whether it's an election or Brexit, for example, the risk is too big that you position your portfolio one way. But in the case of what we're doing now with Russia, it's better just to reduce your risk and reduce your risk before the outcome happens. Unfortunately, what happens is if you decide to be reactive and only do it after the event has taken place, then you already have lost the money and then you're locking in that loss. So for us, it's about evaluating various probabilities and then trying to understand how your portfolio will react to those probabilities. And if you realize you don't have a significant edge in determining what the geopolitical outcome would be, it's much better just to reduce risk on both sides so that when the dust does settle, you have the capital available to take advantage of the opportunities that will present itself.
Absolutely. And then, yeah, I mean, so what you're effectively saying is hedge funds are great risk mitigation tools and strategies to employ in a diversified portfolio. Often they're viewed, though, hedge funds as risky themselves. Why is that? Why do you think that market perception exists out there?
It is because there are risky hedge funds out there. There have been multiple hedge funds over the years that have blown up or significantly impaired their client portfolios. Two that come to mind in the last 2 years is Melvin Capital in the US, who was running a short book which was way too big and too illiquid for them to do anything about. Exactly. And the other issue is that some hedge funds call themselves hedge funds, but they're not really hedging anything. They're just taking on a lot of leverage and going long stocks at like 2, 3, 4 times the actual value of the capital in the fund. And that's an example of Archegos, which blew up at the beginning of 2021.
I think a great example of why not all hedge funds are created equal and why investors should be asking those kinds of questions. Steven Hurwitz, investment analyst with 361, with the ins and outs of hedge funds.